All right, let's talk tax. Have you ever stared at a tax bill and just wondered, how on earth did they come up with this number? Well, today we're going to build one, piece by piece. We use Pakistan's official income tax ordinance as our guide to see exactly how your final tax bill gets put together. Let's jump in.
It's a question we've all probably asked at some point, right? You start with a simple salary and you end up with this specific tax figure. What are all the steps in between? That's exactly what we're going to unpack today. That journey from income to final tax.
You know, the official name for this whole instruction manual is the charge of tax. I like to think of it as the architect's blueprint for your tax bill. It's not just one simple rule, but a whole series of layers, each one adding something to the final calculation. And understanding this blueprint, that's the key to understanding the whole system.
Okay, so first things first. Every building needs a solid foundation. Before we start crunching numbers, let's tackle the most fundamental question of all. Who actually has to pay tax in the first place?
And honestly, the answer is refreshingly simple. The foundational rule for the entire system is this. If you have what the law considers taxable income for a given year, then yep, you're on the hook to pay income tax. That's it. That's the starting line for absolutely everyone.
And look, we're not just making this up. Here it is right from the source. This is Section 4, Subsection 1 of the Ordinance. It says that tax shall be imposed for each tax year on every person who has taxable income for the year. It's about as clear and direct as it gets, and it's the bedrock of the whole system.
Okay, so we've established who pays. The next logical step is how is that initial tax amount actually calculated? Turns out it all boils down to a core three-part formula. So this is the basic engine right here. First, you figure out the tax on your income. Then you apply the official rate. But, and this is super important, you don't stop there. Step 3 is where you can really lower your bill. You subtract any tax credits you're allowed. Think of those credits as a direct discount on the tax you owe. And again, here's the proof, right in the law itself. Section 4, subsection 2 explicitly says you compute the tax by applying the rate, and then, and I'm quoting here, shall be subtracted any tax credits. This isn't some secret loophole. It's a feature, not a bug. It's built right into the system to lower your final bill.
So we've got our base tax figured out. But we're not done. Now the blueprint starts adding some extra layers. The first one is called a surcharge. And this is where the system starts to get a bit more, well, selective. This doesn't apply to everyone.
So what in the world is a surcharge? Well, it's pretty much what it sounds like, an extra charge. But here's the really interesting part. It's not another tax on your income. It's a tax on the tax you already calculated. It's a way to progressively increase the tax burden on the highest earners in the country.
And this is the magic number, 10 million. 10 million rupees. If your taxable income for the year goes above that line, the surcharge kicks in. If you're below it, you don't have to worry about it. It's a very clear threshold.
But wait, it gets even more specific. The law actually makes a distinction based on how you earn your money. If you're a salaried person making over 10 million rupees, you pay a 9% surcharge. But for everybody else, like businesses or other high earners, that rate is a little bit higher, at 10%.
And you can see it spelled out right here in the source text. Section 4A lays out the 10% rate. It mentions that 10 million rupee trigger, and then it carves out that specific exception for salaried folks setting their rate at 9%. It's all there in black and white.
Believe it or not, we're still not at the top of our tax building. Beyond the base tax and that surcharge, there are two final layers, and these are known as super taxes, and each one has its own very specific purpose and its own set of rules.
So let's put these two side by side, because they're different. The first one, from Section 4B, has a very clear social goal. It's for the rehabilitation of displaced people. And notice its definition of income is pretty narrow. It's looking at things like profit on debt and dividends. Now compare that to the second one, from 4C. This one's way more general. It's a tax on high earners, and its definition of income is much broader, casting a much wider net.
Here's the legal language for that first super tax, Section 4B. This has been around since 2015, and you can see its mission is written right into the law, for rehabilitation of temporarily displaced persons. This is a tax with a very targeted, very specific social mission.
And now here's the second one, Section 4C. It's much more recent, from 2022, and its name is way more direct, super tax on high-earning persons. This suggests a much broader goal, probably focused on general revenue generation from those with the absolute highest incomes.
Okay,
Wow, we've climbed all the way to the top. So let's step back for a second and look at the whole structure we've just put together. Let's recap this entire journey, from gross income all the way to that final tax bill.
So this is it. This is the whole shebang. You start with your base tax on taxable income. Then you get to subtract your credits, which is great. Then you have to start adding things back on if they apply to you. The surcharge if you're over 10 million, and then maybe one or both of the super taxes. That's the complete formula.
You know, all of this brings us to a much bigger idea. A tax system isn't just about numbers and rules on a page. It's a story. It's a reflection of a society's priorities and its goals. So when you see a system built with so many different layers, with credits, with surcharges, and with super taxes all aimed at high earners, what story do you think that's telling? Thanks for joining us.